All right. So we have an exam due by midnight tonight. It won't be held during class time. We're going to do a regular class session as we go. But due by 11:59 tonight, we ask that you submit your exam. Wanted to see if there are any additional questions. It's chapters 5, 6, 7, 8, and 13. And we're going to get starting into liabilities today. So I'm going to go ahead and ask that to start out for liabilities, go ahead into Edgar and pick a company. And I'm going to ask you to calculate two vertical or common size percentages. And they're going to be both relating to liabilities. One is going to be current liabilities as a percentage of assets. And the other is total liabilities as a percentage of assets. And I'm going to ask that you post that to the spreadsheet link that I'm going to put in chat. And the link is copied here. I'll post it in the chat as we speak. So I put a link to the Google Sheet in chat. And you want to go into Edgar, pick a company, and pick two vertical analysis ratios, two percentages. One is going to be current liabilities as a percent of total liabilities. And the other is going to be, current liabilities as a percent of total assets. And the other is just a debt percentage, which is your total liabilities, both current and non-current, as a percentage of total assets. So please go ahead and make the calculation and pop it into the Google Sheet, and we'll be on our way. Should take about 4 minutes. You can always do the search on Edgar, EDGAR, jump in. You get the idea that I want you on Edgar. And I want you comfortable using it because it's a pretty powerful tool. And if you just joined us, I will again put the link in the chat for the Google Sheet that I'm asking you to update dynamically. And you're going into Edgar, picking a company of your choice, and taking a current liabilities as a percentage of total assets and total liabilities, both current and non-current liabilities as a percentage of total assets. So this will kind of gauge the significance of what we're talking about when we talk about liabilities. And cameras on, please, if you can. If you have bandwidth issues, I understand, but it's much easier to engage seeing everybody face to face. Thank you. Appreciate that. That way I can recognize you in the hallway next semester, if all goes well. If you still want to see me. Okay. On our way, making progress. The first two are Ford Motor and Tesla. That should be an interesting comparative. J&J. Last class, they did Coke and Pepsi, which is a good, interesting comparison. Current liability percentage should obviously be less than total liability percentage. And I think everybody's got the link, but I'll just double check. I'll pop it back in the chat in case one of you might have come in a little bit late. We are getting the current liability percentage and the total liability percentage. I find Edgar a pretty powerful tool. Not only will you use it in some of your other classes like finance or even potentially econ or management or marketing, but on interviews, on investing, on exploring, finding out about different companies that you might want to work with or work for, obviously needed for the annual report project. I see 5 names so far. Good start. Still have time. Excuse me. About a third of you are done so far. That's okay. We're getting there. Making progress. And basically you do a Google search on Edgar, EDGAR. By now you should be comfortable at least seeing it. There'll be a video recorded on our class videos explaining it. And yes, you'll be doing a 10K search and you'll be looking for the balance sheet. That's a 10-K. Probably want classic view. I find that a little bit easier than use than trying to go through the full 10K. There's a 10Q and 10K button when you go to Edgar, but on the upper right-hand corner, it says classic view. You click on classic view, you can quickly get to the financial statements of the 10Ks. If you want some help outside of class, let me know, set up a time and I'll do a walkthrough with you. And we can reinforce that and go directly. But the video should help as well. Kellogg looks really low, but somebody else did in the last class too, and I was going to check up after today. So I'm going to go into Edgar myself. And if you just want to show and tell, I will share my screen and show you what I'm doing. I go to Edgar on the search. I search company filings, sec.gov. Next, I just go straight to Edgar. And search company filings. Oops. Search company filings right here. And I'm going to pick a company by company name here. Johnson and Johnson, or J&J. I could have just typed in the ticker symbol. Upper right-hand corner, you see the classic version. You could go to 10K here with the plus sign and have 10Ks and 10Qs, but I want to go to classic version. I like that a little better. Filing type a 10-K. I'm going to go to interactive data. Normally I'd click view Excel docs here, but right now I'm going to go, because it'll download all the numbers. I don't have to transpose anything, but I'm going to go look at a consolidated balance sheet, financial statements. And I got current assets. I got current liabilities. Total current liabilities of 42. Total liabilities 111. And my total assets, or my total, is 174. So if I take 42 out of 174, I'm closer to 20%, not 0.2. I think you meant, yeah, I think you're missing a couple of zeros there. That would be closer to 20%. And then my total liabilities, 111 out of 174, is closer to 2/3 or 66%. So that kind of gives you an idea of what we're doing for numbers and analysis. There you go. So by copying the 9.6% up top there, you're not going to get that right. 0.2. Oh, I can't see where my total liabilities are less than my current liabilities. That makes no sense, because current liabilities plus long-term liabilities equal total liabilities. So you probably want to correct that. So trying to copy somebody else's work doesn't work. It doesn't work on exams either. Doesn't work in life usually. So if we're looking at percentages, Tesla has a lot of investment, a lot of equity. Ford Motor has a lot less equity as a percentage of total assets. So please go ahead and double check Kellogg's total liabilities. If I look at them here, I'm seeing my total liabilities, 111,616 out of 174,894. Again, that's closer to 2/3 than it is to there we go. But in summary, as we look at these numbers, and you'll have more time to get that filled in, right? I see a high of 88% with Ford, 85% of Pepsi, of total debt. That's your debt ratio, or debt to asset ratio, or debt to liabilities plus equity ratio. All the same thing, same term, same numbers. So almost 90% debt, 10% equity, down to much smaller numbers. And again, I'm doubting my Kellogg's and the Thicon there. But I see 32% on Domino's, 39%, 40% on Amazon. So we're talking about a lot of debt. And we're going to differentiate between the current liabilities, which usually are not paying interest on. Usually the accounts payables of the world, the unearned revenues of the world, the sales tax payable, the other taxes payable and obligations, other payables, wages payable. We'll talk more about all those shortly. But you look at all those payables and those are things you owe, but you're probably not incurring interest expense on those. On the other hand, if you have notes payable, a signed note, if you got a mortgage payable or bonds payable, those are incurring interest expense. And when we looked at the 10K that you just looked at, you saw a whole bunch of liabilities for a lot of companies. When we looked, we did the same analysis for inventory, if you recall. We had $5 billion of tobacco leaf inventory. And you look at that and said, that's a lot of inventory. And we got to pay for that inventory somehow. We got to finance that inventory somehow. It's on the books, historical cost, whether it's LIFO, FIFO, or average cost, whatever it is. It's not specific ID. I'd hate to identify a particular tobacco leaf, but $5 million worth of inventory had to be financed. We have to buy it, pay for it, finance it somehow, and we're paying interest on that $5 million that we had to borrow. So we're talking not only significant numbers on the balance sheet, but ultimately significant numbers in interest expense. So we got a whole bunch of money that was going out the door to pay for that kind of stuff. So I'm going to go in and we're going to go through a whiteboard example. And this might actually help you on the exam tonight too. And I want to go through and take a look at, well, let's say we're looking at, I'm going to put the text box here. Let's say we have a note payable to the tune of $100,000. And we'll take a 90-day. We've got a 12% interest rate. In the chat, can you type if that's an annual interest rate or a 3-month interest rate, please? Go ahead in the chat, pop it in. Let me know if that's a 12% annual or 12% over the 90 days. Okay. And issued 11/1/X1. We'll pick a year, nothing fancy. So I've got 4 answers in chat so far. I'd like to get a little bit more participation since I grade on that too, and grade on attendance and presence. And I want to make sure. So I got votes for 3-month, I got vote for annual, I got vote for 90 days. Well, let's think about it. If I told you I had a 3% car loan over 5 years or 7 years. By the way, never get a 7-year loan, but that's bad news on a car. That's another story. Or 3% car loan at 3 years. Is that 3% over 3 years and 3% over 5 years? Or is that 3% a year for the next 5 years or next 3 years? Correct answer is 3% a year. The same thing for a 15-year mortgage or a 30-year mortgage. If I said the interest rate was 2.5% on a 15 and 2.75 on a 30, or either way around. Cheap, nope, that's right. Lower rate on a 15, so 2.5%, even down to 1.75 I've seen. But let's say 2.5% on a 15-year note and 2.75 on a 30-year mortgage. That again is an annual interest rate. So anytime you see an interest rate, remember that's an annual rate. That's not 48% a year. That's 12% for a year in this particular example. Okay. So remember, when we talk rates, we always take interest at an annual rate. So this is principal times interest times term. Make sure in proper time period units. So therefore, we have a principal. Now I'm going to ask you to calculate what would the interest, if I have a $100,000 note, how much will I be paying on that note? Payout of note in 3 months. Give me a number of how much I'm going to write the check for. I'm borrowing $100,000, say from a bank. How much of that $100,000, what's my check I have to write 3 months from now, 90 days from now? Go ahead and pop that in the chat, please. Everybody gets to play. And you're right, it's $100,000 plus interest. So my ask is, what's the total interest? And principal that's going to be paid when you write the check. Well, if it's 12% a year, that's 1% a month. And 12% of $100,000, we can do the math pretty easily. 12 out of 100 is $12,000. And if we're doing a monthly, that's $1,000 a month. And my question, when I pay off the note, how much do I write the check for? And if I could borrow $100,000 and 90 days from now pay $3,000, I'm going to borrow a whole bunch more. I'm going to borrow millions and pay back a portion. So I'll give you a hint. 3,000 is not the right answer. It's part of the answer. But how much do I have to write a check for 3 months from now to pay back this note? I borrowed $100,000 today. 3 months from now, I have to pay back how much? Please type it in the chat. And you're welcome to change your answer if you put 3,000. 3 months from now, you bet I got to pay out $103,000. So let's take a look at that. Let's see what a journal entry looks like. So if I'm the payer, let's see, I issue the debt. Okay. So what happens on the day I issue? On 11/1, the issuer puts out $100,000 cash. So they get a notes receivable. You've already done this before. 100,000 cash, 100,000. 100,000. So the receiver of the funds on 11/1, X1 is going to get cash to the tune of $100,000 and have a note payable for that same 100,000. So I'm more concerned. You already know the first part. But now I'm going to ask you another chat question. I have to go in and do a final payment. I'm sorry, I have to accrue, I have to adjust to 12/31 X1. I'm going to record some expense. And I'm going to record a payable. I'm going to record a balance sheet account, the payable, and I'm going to record an expense, the income statement account. In the chat, tell me how much do I accrue on December 31 that I owe. I didn't get a bill for it, so I'm accruing or I'm estimating the amount. So in chat, tell me the dollar amount I need to accrue on December 31. Everybody gets to play. How much do I accrue for 2 months? Excuse me. One answer so far. Let's get some more answers. Take your best shot. I'm not grading right or wrong, but I am grading participation. So I encourage you to participate. So we're doing a principal times interest times term thing. PIT. I have the principal of 100,000 times my interest of 12% times 2/12, right? 2 months out of the year. I've got two answers. I would expect a few more people participating. So I already told you that my interest was $1,000 a month, right? 12,000 for the year. I'm accruing 2 months. So bottom line, you are correct. I'm going to accrue $2,000 worth of interest. Okay. Does that make sense? Because we ultimately have $3,000 of interest, but we have 1,000 for November, 1,000 for December. And when we pay the note back, let's do that. When we pay the note back, let's say it's January, and I know, let's see, 90 days from November 1st, it's 31 days November, 31 days in December. So I got to go into January, which says, I'm sorry, 30 days November, 31 December. I can count these, right? So I got one, I got to go back. So probably something like January, it'll be January 29th or 30th, but I'm going to put January 29th for kicks, pretty close. Maybe I paid it a day early for that matter. So in January of year 2, I need to make a journal entry. What's your journal entry look like? Well, I'm going to have cash going out the door. We already determined we're going to pay back $103,000. So I have 2 more entries. Good, as long as you realize what's going on. Okay. If we go back and take a look and say, well, I already have interest payable that I need to clear because I'm not going to be able to $2K, but I also have in January, for the month of January, interest expense of 1,000, and I clear my note payable of 100,000. So everybody see how that works? Again, this is our AJEs. We've done these before. This is adjusting for December. And we're clearing the payable, we're clearing the note, both the notes payable and the interest payable, and we're clearing the cash because we wrote the check. And the plug is the interest expense. That will fall out in the details. And by the way, again, this will probably help you on tonight's exam when you see that we have to do some interest calculations and money's due. And that was more with receivables, but this is payables. Now we're in the liabilities and we see where we're at. Any questions on this stuff so far? Okay. It takes a little bit of processing, a little bit of thought, a little bit more ideas of what we're trying to do here. But I want to make sure this reinforces our adjusting journal entries. It reinforces notes, percentages, and what we need to work with. So let's go ahead and let's do a new share. Let's go back and talk about advanced portion of screen. And we'll go over to our liabilities. So let's talk liabilities. We talked about current liabilities before and long-term liabilities, but basically a past transaction or event that we've incurred a current obligation to future payments of assets like cash or services, or using assets like cash, but we maybe acquired inventory or whatever else, but services we are due. So we need to supply or do something in the future. So liability is an obligation that can be satisfied with cash or products or services. So if we've got a concert or a football game, we got tickets we sold, the airline sold plane tickets, the game hasn't been played, the flight hasn't been executed, taken off and landed safely, then we still have a liability. We have unearned revenues that show up as a liability. And let's look at some of the other liabilities that go with that. So we have current, due within 1 year of the company's operating cycle, whichever is longer, and we're going to assume 1 year for most everything we do. And we got the long-term stuff that goes with that. Uncertainty regarding liabilities: who do we pay, when do we pay it, and how much do we pay it? Those are the 3 questions to answer. Well, let's look at some of the categories. We've got accounts payable. That's pretty obvious. Trade payables or payables to our vendors. We pick up the phone, send us some stuff, or we send an email or a purchase order, and they send us some stuff and we owe them money. But then there's some taxes and payroll obligations that we withhold. So sales tax payable, that's a liability. We owe the money to the government that we collected from the customer, but it's not our revenue. That's the government's money. Don't spend it. Unearned revenue, we just talked about that. Our plane tickets, our concert tickets. We have short-term notes payable, less than a year. We have payroll liabilities. When you get a paycheck, you get a $1,000 paycheck, you don't get $1,000 to deposit in your bank. You get deductions from that. Include Medicare and FICA, just deducted. With state withholdings, federal withholdings get deducted. What happens to those deductions? Well, the company holds on to them as a liability, not as an expense. We have multi-period known liabilities. So a bunch of liabilities that we accrue for and we're aware of. And I'm going to add one more here, just for fun. That one I'm going to add is something called current portion of long-term debt, LTD. Okay. What's a current portion of long-term debt? Well, if you take out a mortgage or you take out a car loan, every payment you make pays a little bit of principal and pays a bunch of interest. Especially in the early years, it's more interest, and the interest keeps decreasing and the principal applied keeps going up. Which is why after you take out a loan and a month later, you try to repay the loan after you've made a payment, that full payment does not get deducted from the loan. Only the principal portion that you paid gets deducted from the loan. So we have a current portion of long-term debt. A 15-year mortgage is going to be 14 years of long-term mortgage debt and 1 year of current mortgage debt. 5-year car loan, same thing. So that current portion of long-term debt is an obligation, a liability, just to make you aware. So it's a current obligation, it's current debt. Okay. Oops. Let's look at sales tax payable for a minute. So if we've got sales tax payable, we make a sale for $6,000. We record $6,000 in the sales, but we collected $6,300 in cash. So we've got 5% sales tax rate. That becomes a liability. It's not an expense of us. It's an expense of whoever did the buying. And that's included in the asset that they acquire. If there were shipping charges, they'd add that too. But that $300 is a liability, sales tax payable, that we'll write a check for the state and the county. Actually, the county might kick 0.5% in there, and the state might be the rest. So often there's a county sales tax that's part of a sales tax that is based on the state. Here's our unearned revenues. We've seen this before. You go in and say, oh, I've got unearned revenue. I got concert stuff. And in this case, there are 8 concerts that we're selling, but we haven't had one yet. And every time we run a concert, we're going to take 1/8 of that $5 million, which is $625,000. take it out of the unearned ticket revenue, which is now earned, and put it into sales revenue or ticket sales revenue on the income statement. We're transferring it from the liability, the unearned revenue, down to an income statement account called revenue. In this case, ticket revenue or contra ticket revenue. Any questions? Are we all on the same page so far? Now we're going to get a little fancy. The short-term note payable, different from accounts payable, trade payables. Accounts payable, you pick up the phone or send an email and they send you stuff on honor system. A note payable is usually signed, bears an interest rate, and a methodology of time for when it's going to get paid back. So it's a written promise to pay, specified amount within 1 year if it's short term. There's interest associated, even though you might say add 1.5% a month to my bill if you don't pay it in 30 days. That's an 18% annual interest rate. That's more of an understanding. It's not a written obligation. This is a signed note. I sign a 5% note with the bank. I sign a mortgage. And maybe an overdue accounts payable gets turned out. In business, I've been in a situation. Customer can't pay their bill in 30 days. They owe $20,000. Well, they make an agreement with the vendor to say this 20 grand at 10% annual rate, I'll pay back in the next 6 months, or I'll pay a portion every month, or I'll pay it 10 months or 12 months from now. Whatever the agreement is, we have a signed note with a stated interest rate and payment terms. Sometimes it's a bank borrowing, short-term note payable. Maybe you need to cover payroll. So what's a note look like? We just did this. We got accounts payable. We didn't do this. This is terming out the note. Accounts payable is cleared. We get $100 down, and we've got a note payable or obligation of $500, the balance due, and we have whatever interest we've agreed on. And then when the payment's made, we get cash for the 510. There's interest expense. I'm sorry, the cash goes out the door. We've got expense of $10 and $500 clears the note. And if we borrow from a bank, same idea. There's $2,000 what the bank gives you and says, here's cash. We got $2 grand and we got a payable of $2 grand. When we write the check from 2 months from now, we go ahead and say, okay, here's the cash of 2040, which includes a 2,000 note and $40 worth of interest expense. And we did the adjusting entry, end of period. We did that 12/31 end. We had an adjusting journal entry. And you'll see that this is a review, the interest expense we did December 31, $10 worth, and the interest payable. And then on February 14th, we don't have $40 worth of interest expense because $10 of it was from last year, from December 16th to December 31. The balance, $30, is from this year. So we got a total of $20.40 we pay out. We clear the payable of $10. We're only recording $30 of expense this year. Comments or questions on that? Are we making sense? Are we on the same page? Just give me a quick chat. I'm doing, yes, I got it. Or okay, making sense. B, not okay. C, not okay. A, B, C. Yes, I got it. Making sense. Or B, it's making sense, but I need some work. Or C, I need a lot of work. Yes, okay, no is all you need to do in the chat right now, please. Thank you. So most of you are okay with this. It's going to take some practice. Some of this is a review from receivable stuff. So be ready to be quizzed and tested and all this good stuff. And it's on quizzes, exams, finals. It's going to be all the above. And it's going to be in life. You're going to want to know this kind of stuff when you take out a home loan or a school loan, which many of you have already taken out. All right, the next class, I'm going to spend some time talking about payroll. And I'm going to introduce some of the payroll concepts now, so they're not totally unfamiliar, but I want to get a base of knowledge to share. So we're going to talk payroll liabilities for salaries and wages, employee benefits, and payroll taxes. And there's employee portion that you see on your paycheck. You get deductions for FICA and Medicare. There's an employer portion. They have to match that FICA and Medicare, which is 7.65%. 6.2 and 1.45 are the magic numbers. So 7.6, roughly 7.7% of taxes gets taken out just for retirement stuff, Medicare and Social Security. Another bunch gets taken out for your federal withholdings and your state withholdings, which you'll get credit for at the end of the year. And then the employer has something called FUTA and SUTA, federal unemployment tax, state unemployment tax. There's an unemployment fund if for some reason you get laid off. Not if you get fired for due cause, but if you get laid off or the company has to let you go for whatever reason, on their nickel, on their shoulders, you're able to collect unemployment for a period of time, which with COVID, that's been extended for a lot of people as well. So that's what unemployment benefits, they get a fund that's paid into for that. Quick question, survey. How many of you pay property taxes? I've asked this question before, actually. Give me just a yes or no. Do you pay property taxes? Yes or no? Okay. So I'm getting a lot of no's. I saw one yes in there. How many of you rent off campus? Do you yes or no? Not on the dorms, but do you rent off campus? So actually, I see a lot of you paying rent off campus. It's probably no shocker to realize that you really are paying property taxes. You say, wait a minute, I don't write a check for property taxes. Well, you write a check for rent and your landlord pays property taxes. And I'll just ask a facetious question. Do you think your landlord would charge you less rent if they didn't have property taxes to pay? And the short answer is, yeah, big time. So if they're paying $200 a month for property taxes on the unit that you are renting, you think your rent would be $100 or $200 less if they weren't paying property taxes? You bet. Which is kind of one of my personal bugaboos. Corporations don't pay taxes. Actually, some corporations pay zero in income tax. But other corporations, even though they write the check, they're not paying the taxes. Their customers are paying the taxes. Right now, federal tax rate is 21%. They're talking about jumping it to 28%. So what does that mean? It means that extra 7%, out of the goodness of their heart, they're going to write a check to the government and say, here, you need the money more than we do. No, they're going to charge their customers more to keep their margins, to pay their bills, and to take care of the profits and whatever distributions to owners and the community and involvement. They're going to raise their prices. If they weren't paying property taxes, they could charge less. One of the worst commercials I ever heard was AT&T, 20 years up on this land. Now we're going to get our property taxes. That mean old AT&T is going to pay us. Well, it's not AT&T. The rates on everybody else's phone bills went up. And the customers are paying those property taxes. So be careful when you think about taxes and the perspective on taxes. All right, so we're looking at payroll liabilities and obligations. So let's talk about some of them. So you get a deduction from federal and state income taxes. How many of you, let's do one more chat question. When we get a return, tax refund, how many of you like getting big tax refunds? Say yes. And how many don't? Say no. Yes, if you like getting big tax refunds, and no, if you don't. A couple answers. Kind of mixed bag, 2 and 2 so far. I'm gonna participate in this one. And it's a big no for me. Why don't I not want a big tax refund? What does it mean? Well, if you made $25,000 and you paid $3,000 in taxes, and your tax obligation was only $2,000, you get a $1,000 refund. That's nice. Except you pay $3,000 in taxes when you only owed $2,000. Well, that means you overpaid $1,000, so you're getting your money back. By the way, taxes, yes, are your money. I rather spend my money and keep my money and invest my money on the things I want to use and not give an interest-free loan to the government. That's my personal. Some people like getting a big refund because it's forced savings. They know they're going to spend the money when they get it. So getting a refund of $1,000 feels good, tastes good, smells good, because it feels like a bonus at the end of the year. And that's okay. But just realize that's your money that you're getting back. It's not the government's money. All right, federal, state, and local taxes, voluntary deductions, FICA, and FICA taxes. So let's talk about FICA for a minute. We got 6.2 in Social Security, 1.45 in Medicare, 6.2 goes up to a cap. That's your own Social Security, that's your own retirement fund, basically. So 7.65 you pay, and by the way, the employer is going to match that. Federal and state withholdings, again, those are liabilities that the employer sets aside, like sales tax payable. They have federal income tax payable, state income tax payable, payroll taxes payable. Not expenses of theirs, not income of theirs, it's a liability. Other voluntary deductions, it could be union dues, savings account, insurance premiums, health or life or disability. Charitable contributions, maybe United Way set aside. And then we've got an employee entry here. So the cash of $1,500 received here is based on a salary expense of $2,000 and a whole bunch of payables. FICA, Social Security, FICA, Medicare, federal income tax payable, employee medical insurance payable, union dues payable, and then the salaries payable is actually cash that's going to go to you ultimately. Okay. An employer also has a bunch of deductions they need to worry about. They match your FICA and Medicare. And they also have something called SUTA and FUTA, federal employment and state unemployment, based on the first 7,000 of wages. We're going to, as I say, go Wednesday in a lot more detail and talk about your paychecks, which is near and dear to all of us. But the point I want to make here is, why would a company not want to have an employee and rather have a subcontractor? Let's say they hire somebody to mow their lawns, or they could buy a lawnmower and pay an employee to do it. Well, the employee gets benefits like vacation. They get benefits like any type of vacation time earned. They get insurance benefits or other benefits from the company. And additionally, the company has to pay FUTA, SUTA, and FICA on you as an employee or the person that's going to mow the lawn, where they can hire a subcontractor, not worry about vacations, not worry about any other obligations and taxes, and just write a single check. A lot cheaper to have a subcontractor. So ideally, people want to hire subcontractors in general than employees, although you think with employee you have more commitment, which is usually true, and they're dedicated to your organization, not cutting anybody else's lawn, but they work for you. So there's balancing act there, but payoff, subcontractors get away with more. Now, don't worry about the FICA, because even as an independent contractor, as a corporation, independent sole proprietor, you're not going to pay 7.65%. You double that to 15.3. The profits, you're going to pay 15.3% of that if you have your own business. So you're not going to get out of the FICA employer match and employee match, or the employee and employer portions. So just want to make you aware of that. Based on where we're at, that's what I needed to get through today. And as I said, on Wednesday, we'll talk more about payroll, near and dear to all our hearts. Comments or questions from today? Then I wish you a great week. Good luck on the exam. Tuesday night, you'll be able to catch up hopefully on the homework if you don't catch up on Monday night after the exam. And we'll look forward to seeing you on Wednesday. Have a good one, or two, or three.
Have a good day.
You too. Thank you.
You do that, Scott. Thanks.
Appreciate that. Thank you.